mentioned. They're going into overdrive. And so we think that's very exciting. And that's part of the growth story moving ahead. And importantly, it's part of the productivity boom we see emerging. And productivity is going to be very important in terms of not only holding inflation down, but driving it down. And we've been saying this for quite some time. Inflation may seem stuck in the 2 to 3% range right now, and tariffs are aggravating that, of course.
Cathie begins by examining the trajectory of the US dollar, noting that over the past 15 years, it has maintained a steady upward trend when measured against both major and broad-based currency indices. While there has been a recent pullback, she emphasizes that the long-term bullish structure remains intact. In her view, the dollar is now entering a period of stabilization, settling into a new range that reflects the underlying strength and resilience of the U.S. economy relative to other regions. She supports this outlook with a clear rationale. If her forecast of a powerful, innovation-driven economic boom in the United States proves accurate, investment returns will continue to outperform those of other nations. Such superior returns tend to attract significant global capital inflows, which in turn reinforce the dollar's position as the world's dominant and most stable currency.
But we would not be surprised to see inflation drop in the years ahead to zero or even negative. Because we think the innovation that's taking place now is going to be pretty explosive. And technologically enabled innovation is deflationary by nature. It follows learning curves, which are expressed in cost declines. It's all about efficiency. And so we think that's going to be a big part of the story. And here you can see, and I've repeated this a few times, but it is important in terms of attracting investment to the United States. Adjusting for what I just showed you in terms of the depreciation schedules, the effective corporate tax rate, the tax rate today is 21%, down from 35% in the first Trump administration. He got it down to 21%. Now they're not operating on the tax rate as much as they are the effective tax rate through these depreciation schedules. And that will get taxes down to roughly 12%. I was just in Hong Kong, which prides itself on very low tax rates, corporate tax rates, and that has attracted a lot of investment. But if you look at the tax rates there versus in the United States, at an effective tax rate of 12%, we are below Hong Kong's 16.5%. I believe they have, for very low levels of corporate income, up to, I can't remember, 100,000, something like that, 8%. But beyond that, and that is what we're talking about, 16%, we are lower than the Hong Kong schedules. That's important and interesting. And we're about as low as Ireland. Ireland's I think it's a 12% tax rate, has attracted enormous investment, particularly in the pharmaceutical area and the tech sector. And we think a lot of that investment, again, encouraged by the Trump administration in all kinds of ways, a lot of that will make its way back, at least partially back. So now on to monetary policy. So you can see here in the purple line is money growth, the growth in money supply. You can also see going back to the early 60s, we've never seen money supply drop as much as it did in recent years, but then again, we never saw it boom as much as it did during COVID. So that adjustment process is pretty much over, and you can see at 5%, it's still below the average of this period. Really, it's post-World War II period. Now, you can see the green line is CPI inflation, The money supply has been pushed ahead by 18 months, and many people think that the inflation rate follows with an 18-month lag. So they are concerned that inflation is turning up from roughly, I think it's 2.7% right now, and will follow money growth higher. And even today, I think one of the Fed governors, Goolsbee, said he's concerned about services inflation, and we'll show you a chart in a moment about that. So this is top of mind for the Fed. I think that Chairman Powell is very focused on services inflation as well. But we have reason to believe that services inflation is going to decelerate quite significantly. Housing or large part.
Cathie notes that early signs of this momentum are already visible in the job market. Even recent unemployment figures reveal subtle but meaningful shifts, reflecting how automation, artificial intelligence, and digital innovation are beginning to reshape employment patterns across industries. For investors, she explains, this transformation presents extraordinary opportunities. Companies that embrace and effectively integrate these technologies won't merely survive economic transitions, they will lead the next major phase of growth. In her view, these forward-thinking businesses will define productivity standards, capture new market share, and drive the innovation cycle fueling the broader economy's expansion.
Parts of housing is a part of service inflation, and I'll show you in a minute. Housing price inflation is decelerating on the existing home sale side and continues to drop on a year-over-year basis on the new home side. And there's reason to believe that drop will deepen in the next 6 to 9 months. So I want to show you a very important chart now on why we think money supply growth is not going to fuel inflation, or this recent acceleration is not going to fuel inflation. This is a chart of M2 velocity, that is the green line, and mapped against the labor participation rate. Now, velocity is the rate at which money turns over. And in 1997, it peaked in the United States. And it had been increasing secularly for decades. It peaked, and as you can see, it has been falling for the last 25 to 30 years on balance. Now, it is cyclical. When we go through a downturn, a recession, velocity drops, and you can see here it collapsed during COVID. Why? Because people were very afraid, and so they held back their on spending, especially in the beginning, thinking that we were all going to lose our jobs, the world was entering a global depression, and we needed to save money, save it for that very rainy day. And so it collapsed. Cyclically, it has moved up, but it moved up. If you were to look at a longer-term chart, and we'll provide that in the next in the know, it has moved up to where it should, and now it is starting to fall again. And we think there's reason for it to continue to fall cyclically. But this chart explains why it has dropped secularly. As the labor force participation rate has declined, velocity has declined. Now, what may explain that? Maybe 2 income households moving down to 1 as they have children. That's a possible explanation. In terms of other explanations, some of it is they don't declare they're in the labor force. They are in the gray market, and so That's a possible explanation as well, whether it involves immigration or what have you. And I'm sure there are many other reasons, but this is the only relationship that we have found to explain the decline, the secular decline in velocity. So if the velocity of money is rolling over again, then that is going to diffuse money of its inflationary power. It takes away from that inflation risk because, again, the rate of turnover in money goes down. Savings rates go up. People are more conservative. And from a cyclical point of view, we also think velocity is falling because, and we'll get into this more with the labor report, there are a lot of people who are afraid of losing their jobs because of AI, and that's in the higher income households and automation generally.